Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'm your co-host, Tom Schneider, CMT with NinjaTrader. Before we get into the good stuff, I want to remind everybody that futures and options trading is not for every trader. Contains substantial risk. You can potentially lose all or even more than all of your initial investments. So that's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. Doesn't extend your retirement horizon if you do lose it. Doesn't keep you up at night. Also, want to remind everybody that past performance is not necessarily indicative of future results, and what we talk about here on this program contains neither trade recommendations nor financial advice. It should be used for educational purposes only. And with that out of the way, it's my pleasure to welcome back Anthony Crudele. Anthony, how you doing?
Doing great, Tom. How are you?
Doing well. Really interesting week so far. It's been very busy, but always great to stop at, after that initial opening of the market. You do your pre-market, you got that initial opening, and now you have some time to talk about the market. So always good. I always look forward to our time here.
Yeah, same here. And thank you to everybody who continues to tune in every week. And we see more and more people engaging in the Ask DYE questions, which I always like to remind everybody, you got to follow NinjaTrader on Twitter and you just use the hashtag Ask DYE or tag me and tag Ninja, and then we'll answer your questions within the show. And one of the things that I get DMs about is consistency, right? What does it take, Anthony, to become consistent? Because we all know, we've all been through this. At the beginning of our career as a trader, the first thought is, how much money can I make? Right? So all we could think about is how much money can we make? We never come into this business thinking about how much money can we lose, right? Because our mindset is wrapped around winning. I get it. I was the same way. I only thought about dollar signs. Then when we finally lose money, then we start thinking to ourselves, okay, now I have to kind of put a limit on how much I can lose. And I think about how much money I can make back. And when you continue to struggle and you make it back and then you give it back and then you make it back and then you give it back and then maybe you're in the hole again, you say, man, all I want to do is be consistent.
Yeah, I agree. And when you're first getting into trading, maybe you got into trading like I did. It was interesting to hear the stories of people who had good trades, right? You're thinking of the home runs that you hear about that people talk about, maybe acquaintances or something you read about, but they don't tell you all the time about the singles, the doubles, or even the strikeouts, right? So I think it's trying to get those singles and doubles rather than the home run that could put you on that better path to being consistent. And I totally agree. I want to be consistent.
And I think the first thing that we have to do is define consistency, right? Because whether you're a day trader or a swing trader, a position trader, a long-term investor, right? Consistency can be pretty different for all of us. Because for a day trader, which is what most of the people in this audience are, is how do I make money every day and ultimately every week and ultimately every month and every year, right? But the reality is expectations coming into this business set a negative tone because you're only thinking about money and you're only thinking about making money every day. So right away, you come in with high expectations and without question, you will fall short of them. Nobody makes money every day. Nobody makes money every week. Nobody makes money every month. I don't care what they say on Twitter. So when it comes to that and knowing that and understanding that, and you believe in that, then you slow things down and you start to say, what is the keys to becoming a consistent trader? And for me, how I finally got consistent was understanding the context and nuance of the day. It was not about making money every day. It was about me coming in and being the best executor of my strategy based upon the context of the day. And right now in these markets, you are challenged every single day with a different headline, with something different that's driving the market. And it's really difficult to come in every day and say that your strategy is going to have a winning edge. This is develop your edge, right? So to develop consistency, you have to peel it back and you have to find out what is the leading indicator. And it doesn't necessarily have to be something that's a technical indicator. It could be something that is a fundamental reason, a news headline, a different market, right? It's some sort of indication as to what is leading the day, because every single day has something about it that really carries through the entire day, right? Very, very seldom does a day not have something in the morning that is triggering the moves in the market that by the end of the day, it's forgotten about, right? And maybe the other day with CPI was one of those days that you could kind of say, you know what, inflation came in hot, probably going to be bearish for markets, and the markets come in and grind all the way back, right? And so there's those types of days that are going to happen as well. But you understand that CPI lately is just a day that's, of really kind of just a screw job type day, because it's so difficult, because you're trying to identify how much it matters to the Fed and then what the Fed is going to do next. And so everybody has weak hands. And by weak hands, I mean that nobody wants to sit on a losing position. So if you're short and it's not working, you're burning out. If you're long and it's not working, you're burning out. And I'm talking day trader type stuff. So therefore you have a lot of chop. So you understand the context of the day. And I think that that is the first step.
So Anthony, when you say context, is it almost like you're coming to your desk, your work area, and the first question you're trying to answer is this a good day to trade for me, right? For my strategy?
Well, I come into the day solely thinking about what is the driving force of the day, right? I come into the day and say, what is happening that supersedes my strategy? What is happening that matters more than my technicals? And some days it's nothing. Some days it's only about your technical strategy. Great. That should be relatively easy to understand how that day should go, because either it's your market's proving to you your strategy is working, or it's proven to you it's not. The market feedback is all you need. But you get days like today. I think today is a perfect example. Let's walk back today. What is today? PPI comes out a little bit hot. You got a bad Philly Fed number, and you come in and you hear all the macro people talking about, well, basically, how is it possible to have a soft landing when you have this type of scenario? Hotter CPI, PPI, and now you've got Philly Fed, which on the manufacturing side is not the greatest thing right now. And what you have is this environment where you're getting confirmation almost off of what happened with CPI to then say, look, at this day is going to be hard for being long equities, because interest rates are going up, 10 years going up. I'm going to pull up a chart and talk about that. And the dollar is continuing to rally. So when you have dollar strength and you have interest rates going up, that is not the recipe for equities to have a positive day. And that's going to stay pinned the entire day unless the 10-year pulls back, the yields I'm talking about, or the dollar pulls back and you start to see that, mean reversion back for the day. But if they stay pinned on their highs, there's no way I'm buying into any strength in the S&P. I'd rather miss it, because it doesn't make sense to, right? The other day on CPI was a little different, because although the 10-year was rallying, it wasn't breaking out like it is now, and the yields I'm talking about. And you also have multiple things happening, confirming, and the market reaction is a little bit different. This morning we open up and weakness is just staying there, versus on CPI, they were fighting it relatively early. So you identify what the day is, right? And nobody knows exactly how the day is going to end up, but we do know what is going to be the driving force of the day.
Well, and you throw in a Fed speaker, Mester, who's saying that, well, maybe we have to do more than 50 basis point rate hikes in the next two meetings. There's a 50 basis point rate hike is on the table for one meeting. And then you also have options expiration coming tomorrow. Like, there's a lot coming in today that's not, like you said, just technical. It's a lot of economics. It's a lot of being aware of what some of these Fed speakers are saying. And then you've got just the structure of, here's options expiration tomorrow. So a lot of stuff. It's a lot of churn, I think, today.
Exactly. And let's pull up the chart. I want to show something now. I'm a visual learner, so I think that everyone gets the idea of, okay, when you come in, what are we looking at now? And what I look at is this. If the macro environment, the macro backdrop is going to be a leading indicator for the day, which I believe it is for today, right? The technical side of things aren't really what matters. Because if you ask me personally, I would say technically we're still relatively strong. And I think that the high of the year is probably still not made in S&P. But when I look at today, that is not the case. So today I only look at short. And so what happens is the first thing I look at in the morning is the dollar. I don't have a dollar chart up, but I see the dollar is rallying a little bit. And then you go to the 10-year. Now, this is the micro 10-year yields. Now, many of you may not even know what this is. It's the symbol 10. I think just 10-year on here, 10YR. And that is not your typical 10-year futures. Most people that have been around a while know that that is going to be a different market, right? That's going to be a market, and then it doesn't show you what the actual yield is. This is actually the yield. And why I pull this up all the time is because before you'd have to go and see what is the yield for today, and you'd look at it, whether it was on a Bloomberg or something like that, to find out. Now you actually have a futures market on the actual yield. So I can go in and see it, and you can trade this as futures too. So this is a tradable product. And you could see today that the 10-year yield now is breaking out to the highest it's been for the year, right? It's back to the highs of the year, and it's the highest it's been since September or since December. So what does that tell us? It tells us that that soft landing, basically that yield curve inversion, right? You're getting the middle part of the curve starting to rally, right? So that could mean that you're going to have higher for longer, which immediately right now is the buzzword for equities are in trouble, right? Because most people are anticipating now, which I still think is wrong, but that's for a different conversation, the fact that the market is going to have a soft landing and basically everything is going to go right back to the way it was, right? And the Fed is going to be cutting rates at the end of the year. They're not saying that, but yet the market believes that. And it's actually not a high probability. And so therefore what happens is you get people chasing equities higher, which is, once again, comes into the context of the year. But when they chase them higher and all of a sudden the narrative shifts a little bit, you got a problem. And so ultimately, that's what spills over into a day like today, where you're like, oh, well, I've been waiting for a pullback or all this different things. Well, the bottom line is the bulls have momentum. And I said this the other day, markets are in a mode to make highs until they find a high. They're in a mode to make lows until they make a low. And the action to me isn't screaming bearishness in the S&P, even though a lot of the bears just want to keep trying to find and pick tops. Eventually, we'll find out when the high is in, and maybe it's in, but ultimately it doesn't feel like it. And eventually we start to move lower. But on days like today, the driving force changes the narrative. It changes the tone. It changes the sentiment. And it's because of the yields. So once you get pinned to something like this, now the rest of the day, I understand that I'm only looking at one side of the market. I don't need to be focused on trying to buy the dip today. Why? I have no reason to. As long as these things stay pinned near the highs until they come off, which they've come off a little bit, that's when we can rally. And so that's like phase one, right? Understanding it and really getting to the point of committing to this is the type of day it is.
So quick question. And by the way, if you're watching on YouTube, thanks for that. You can come over to ninjatrader.com/events, join the chat by pressing the big old play button, putting a handle in, and you can ask Anthony any question you want related to this topic or related to trading. We'd be happy to have you do that. I notice you're looking at the 10-year, Anthony. We hear so much about the two-year just because it's been so high. Is there any point where you would look at the 2-year over the 10-year, or you like the 10-year because it's kind of that medium range?
Well, I like the 10-year because you want to look at the longer end. I mean, if you consider 10 years a long time from now, but you do want to look at that because that's where basically if the 10-year is going up, that's where you're going to be more sensitive to equities are going to be more sensitive, right? Because if the 10-year yield is going up, that is saying that, look at, I even got an email this morning from one of my banking people saying, oh, look, good news, rates are going up again, right? Well, good news for me with money in there, right? Not good news for stocks, right? I mean, right now you can get a 6-month CD for 5.5%. So, okay, well, why would, if you've made money in the market so far this year, I personally have taken some money out of the market that I've made and I put them in 6-month CDs. Why not? Because I'm going to make 5.5%. And this is my long-term portfolio that I'm trying to balance. And, but for the bigger, for the people that are managing these big amounts of money, They really can't do that, because if they don't play catch up to what they did last year, they're in a world of problems, right? Because they're going to get people pulling their money out. So ultimately, you have people chasing equity prices, which I think probably continues to happen, at least maybe for the end of this quarter, unless something dramatic changes with the Fed in the next meeting. But these news cycles along the way, you got to keep an eye on the 10-year, because it pushes back on it, right? And it gets the weak hands out. That's the point of it, right? As I said earlier, when you have news-driven events, it gets the weak hands out. That's what it's meant to do. The market is always going to do that. And so for those that are sitting long, trying to continue hold for highs, days like today they're going to be squeeze events, right? And now anything's possible. Could it come all the way back? Sure, it could. But the 10-year, to me, if it stays up here above really 3.8 and a quarter, I mean, it's hard for me to say, oh boy, I can't wait to look for S&P to, come all the way back. And so then I start looking at the technicals and I say, where are we for the month? And what are the things that I talk about every week on this show, Tom? And I always talk about this, the order flow tools. I actually have a link in the description that talks specifically about the order flow tools in the YouTube channel and on my website about this. So if you're not familiar with it, you can go back and watch previous episodes. But this is a auto-anchored VWAP to the beginning of the month. It tells me what the month is. And what is something that I always say, Tom? The cleanest months are when you're above that VWAP and it's just green and it continues to hold, right? When you're below that VWAP and it's red and it continues to hold. You see a lot of smooth months. Look at February. Look at February. Yeah, I'm above it, I'm below it. I'm above it, I'm below it. I'm above it, I'm below it. There is really no clear trend, right, for the month of February. You also have the top Bollinger Band peak coming in and the bottom coming in. Volatility is now contracting, right? We go from volatility expanding to volatility is contracting. So we have this situation where you can expect a lot of choppiness in the market. And so when you see this, I start to look at it and say, I want to look for selling on a day like today because of the 10-year. When we get these rip ups higher, like right now, 41.30, one thing I'll actually go to, and I'll pull up the 3-minute. What I always go to look for is this. You know how I normally pull up? I'll normally pull up a, let me get my horizontal line here, a horizontal line on what we did on the opening 3 minutes. I change that on days like today. And what I do is I take the horizontal line on a 3-minute chart and I box out the 3 minutes of action from the 8:30 number. Now, why do I do that? I do that because this, to me, was the initial overreaction. It's always an overreaction because algos and HFTs are going in, the market gets thin, and they're going to try and move the market as fast as they can in any one direction. And that today was lower, right? Now, when we get back up in here, I start to look at it and say, this is the point that I look at. We're back to the scene of the crime, as some guys would say, right? And you come back up in here and I say, this is the area where if I have some technicals that tell me to be short, I start to look to get short in this boxed out area because this is the area that we got the news. So unless something really changed, like you're not selling down here. I actually did a morning video on Place Your Trades, which I talk about event contracts. I said, wait for 41.20 to 41.30-ish area to start looking for short opportunities if you have technicals that support it, right? And so what you have on a day like today is my mindset is, and this is back to being consistent, I'm consistently looking for one setup. You're not here seeing me selling to the low. You're not seeing me buy, looking for the bottom. I'm not doing things to get myself trapped, basically, right? I don't want to get myself into doing too many things. I'm waiting for one specific setup. I have not done one single thing in the S&P yet this morning because I was waiting for a rally back up to see how it responded. If I saw weakness, then I would get short.
So that's really interesting because this is the first time I'm hearing of your strategy, but it makes sense, right? In a choppy market, you're not waiting till 9:30 because the news is so big today. At 8:30, you're marking your first 3 minutes opening range. Call it opening range. We'll call it the something else, but the important area. And there's really no clear designation from that daily chart, right? Like you said, we're consolidating. Volatility is going down. We're up above and below that VWAP band, right? So, there's really no no particular, I would say, trend that's easily discernible. So you have to dig down. But interesting that you're moving it to 8:30 when the news event dropped. And could that change depending on the news event, right? Most news events that are moving the markets like it did today are at 8:30, right? PPI comes in at 8:30 when it's released.
Exactly.
CPI, the same thing. But you could do a different time period, right? If it was 7 o'clock, if mortgages for whatever mortgage applications move the market, which I don't think it would you ever do that for earnings events, like an Apple earning event, if that was the big
Sure.
driver? Yeah,
Well, the difference would like it would be if I was trading Apple stock, but not if I'm trading the
sure.
S&P, right? But when you look at what's happening today, so you look at this recent rally in equities that we're just getting right now, the 10 years is the leading driver of it. They broke and equities rallied. So when I go back to look at the S&P, I look at it and go, where are we relative to the VWAP for the month? The VWAP for the month comes in at like 41, I think it's like 41.37 or something, 35 right there. Okay. And you go to my 3-minute and I look at it and go, it's pretty much right where we are. This is the area where you start to look at and go, if they start to fail from here, if you have some technical reasons, I'm not here to talk about strategy. I'm here to talk about consistency. It's mindset. Coming in, I'm looking for one single thing.
Yep.
I'm not looking for something else. I'm not looking for longs today. Like, I don't care if this market rallies, great. I missed it. I don't care. I already said coming into it, I didn't think the S&P high for the year is in. I think it's a push and pull market. But what I want to do, and the keys to consistency are context and nuance. If I understand on a day like today that something else is driving it, this is people once again chasing equities, in my opinion, right? Because the way I look at the market today is that anytime we're going to get an overbought RSI into resistance, maybe there's a VWAP there, maybe there's something you have. I like that as a short, because for me, how you develop consistency as a trader is not by consistently following your same strategy every single day. It's by becoming the best executor of your strategy in your market, right? Because your strategy today is, I hate to say this, but it's irrelevant in the scheme of things, because today it doesn't matter. Today, bigger picture is moving through short-term technicals. So most traders are going to get chopped up on a day like today, or a day like the other CPI day, or a day, or in a month right now, really, when you go back to the S&P and look at where it is chopping around the VWAP, which I always say is a very good tool to tell me what the current market sentiment is, right? It's just confused. So you have to understand that consistency comes from identifying the day and just committing to it, right? I may be wrong. I'm wrong all the time. It doesn't bother me, right? Because I know what I look for. To me, it's a win if I come in and I lose, but I know why I lost. Because there's nothing worse than coming in, following your strategy perfectly and saying, wow, I just been getting chopped up lately. Is it me? Is it my strategy? What's going on? And there's that unknown. And that's why you never develop consistency. People don't develop consistency because they never are sure if it's the market environment. They're never sure if it's the strategy. They're never sure what it is. See, for me, I know today, look, my strategy might give me a good buy signal. I'm most likely not going to take it. And some would say, well, why wouldn't you? Well, I said, because there's a bigger reason driving it. Now, today that might work, but the next time it may not. Over time, I'm not a machine. If I have a great strategy, I'll automate it if I think the technicals are so great. I know that my strategy makes money because I'm a better executor of it. And whether you have to know all of these things. So consistency comes down to knowing yourself, knowing your strategy, and understanding the market environments and when your strategy does the best. And I know personally, that's why Fed days, I've struggled. CPI days, I've struggled. Because if I'm just solely going off of my strategy, I a lot of times get chopped up because there's more slippage, there's more things. So what you do is you pull it back and you identify what is the narrative for the day. And once you have that, it really doesn't matter if you're right or wrong on it. I know some people will be like, well, Anthony, I'm not like you, or I can't figure that out. You don't need to be perfect, but commit to something. And be consistent with the commitment. That's where consistency comes from.
And that's great. And Anthony, you said something in there, I just want to maybe clear it up a little bit. You said a good buy signal. And why would you pass on a good buy signal? Well, you don't know it's a good buy signal until the event has happened, right? And the
Correct.
opportunity has happened. In 2020 hindsight, you could say, yeah, that was a great signal. But in the moment, if it doesn't go with what you've decided about the day or what you're comfortable trading, that's the consistency part, right? If
Exactly.
I don't feel comfortable with this, I'm not going to take that. And if it turns out to be a winner, so what, right? You being consistent seems to be the key driver here.
Every strategy signal works sometimes. Nothing works all the time. How many times have I tweeted it and said it? But so many people are hell-bent on, I have this great strategy with 80% probability, but yet a lot of them barely make money, right? Why is that the case? It's because they don't know how to take advantage of situations when the strategy is giving them signals and the market is really giving them great feedback. And it's when the times where the market environment doesn't suit their strategy, they have an additional loss or a bigger loss than they initially wanted. This is the difference. This is what separates people over time, because anybody can learn a technical strategy, but why can't anybody make money? Because of these simple things. They don't put it into context, right? And and no doubt, of course, if you do need a strategy that has a winning edge, there's no doubt about it. I talk about that as well. But you need to pull out the most that you can of that edge when the situations are supporting it. Days like today, the driver of the market is not technical. It just isn't. And you can say what you want and say, oh, I picked the low or I got this, or that's great. But over time, will you exist long enough? And that's the difference. And consistency, as I started off with, what is consistency? Consistency to me is being in business for my 25th year, which is coming up starting in March, right? Can I still be here, right? Can I still exist on this platform, right? Do I really feel that I have an edge coming in every day, every week, and every month? And if I make some money, that's obviously the goal, right? I need to be able to be consistently winning money over time. And over my 24-year career, I've not won money every day, every week, every month, every year. I had losing years in the middle of my career after having 7-figure years. And you say to yourself, how's that possible? Right? I had my worst year off of my best beginning part of the year. I came into that year and I was up mid 6 figures for the year. And I ended up down mid 6 figures of the year. All that happened off of the first month of the year, because my biggest lesson is that I continued to try and push something that was no longer working. It was no longer working. And so my mindset was wrapped around this idea that this is what got me here. This is what's going to keep me here and get me there, because I was in a market environment that was just perfect for me for many months. 2008 into 2009. And then all of a sudden it totally changed. From the beginning of 2009, all of a sudden we got into that bull market, and here's me pounding shorts every rally and just getting crushed. So it's like I didn't adapt and change, and therefore my consistency got blown out. And that it was a major lesson for me. And that is one of the things that I learned is like, Anthony, you've got to come in and identify the day. You can't say that we're just in a bull or bear market. You will be burned out. And it just won't work. Identify the day, commit to it, and stay true to yourself and what your risk is, and consistency comes from then.
Well, I'm glad you were able to recoup from that that year and keep you in. Congrats on 25, by the way. Just real quick, because we're running up against time, maybe we can handle the question of the week real quick before you handle your business. We had a tweet from Anissa. Thanks again, Anissa, for contributing. How many instruments would you recommend for intraday trading? Would you recommend pairs trading for intraday flat at the end of the day? Thank you.
I'm flat at the end of pretty much every day, especially these days, unless we're in a trending market, then you try to hold something, because I don't ever want to get out of anything that's a winner, right? And so I always trim a position to try and hold it as long as I can. These days, especially in February, I'm almost going home flat every day because of just the way that the market was been. And I talked about this almost all of January. I stayed long, and I talked about that on this show. How many different products do you look at? I mean, to me, there's a handful out there that I look at, and I really don't think for somebody who's been trading under 2 years should be looking at more than one, maybe two products. I think if you've been doing this for greater than 2-3 years and you've had some success, I think you can expand to a few products. I think going beyond that, it then comes down to like, how much experience do you have with understanding these other markets? Every single market has a different type of personality. S&P is not crude oil. Crude oil is not corn. Corn is not gold, right? It doesn't spill over, and technicals do work differently in them. So you need to really be on a solid footing before you expand and go into other markets, which is one thing I'll talk about before we go. And this micro treasury yield, I talked about this today. And I think that if you go to cmegroup.com and you learn about what micro treasury yield futures are, number one, even if you're not trading them, I think it's a great product to pull up. So go back to Anissa's question. I think maybe you start to pull up some products like the micro treasury yield futures, look at them just to see what they're doing. This tells you what the 10-year yield rate is. It's tradable as well. Maybe as you start to watch it, you get a feel for it and it becomes a product of yours. But I think for all traders, if you want to see what's going on in yields, because I think it's so important, especially related to trading NASDAQ and S&P and Russell and Dow, pull up the micro treasury yield futures.
Awesome. Anthony, thanks for that. Always great to have you back here and spend this half hour with you. We'll do this again next week. If anybody has questions, like Anthony said, you can go on Twitter, send them through Twitter. Just make sure you're following NinjaTrader. Use the hashtag AskDYE. If we use your question, you live in the United States, just be sure you're following NinjaTrader. We can get something out to you for contributing. Where can people find you, Anthony?
Go to Anthony Crudele on Twitter. Everything spills over from there.
All right. Well, thank you so much again. And thanks to all of you for joining us. I'll be back at the end of the day with bars closing. In the meantime, have a great trading day.
See you, everybody.